all team members in our retail bank provide the best service to our customers. Secondly, we recently announced the elimination of product sales goals for everyone in retail banking effective January 1. Today, I am announcing that we are accelerating this process and ending all product sales goals effective at the end of this week. We want to make sure nothing gets in the way of doing what is right for our customers. Also, we now send out to all customers a confirmation email approximately 1 hour after opening a savings or checking account and an acknowledgement letter after a customer applies for a credit card. We're also making it right for customers. We have begun contacting the customers with open credit cards identified by PricewaterhouseCoopers to determine whether they wanted these credit cards. It's early in the process, but so far we have reached more than 20,000 of these customers and talked to them about their credit card accounts. Fewer than 25% have told us they either did not apply for the card or they cannot recall whether they applied or not for the card. For those customers who want the card will remain open. For any customer who does not want their card, we are closing the account and informing the credit bureaus. Any fees these customers may have paid already has been refunded, and we are developing a process to deal with any other forms of harm. For deposit customers, we have refunded fees and are contacting every single one of them across the country to ensure that we have a full understanding of every customer affected by this problem. In addition, we are voluntarily expanding the scope of the reviews we have done to go back in time to 2010 and 2009. While these issues we will discuss today are deeply disappointing and will take time to repair, they do not represent the true culture and nature of Wells Fargo. Some have suggested the problem was cross-selling, but that is not the case. At its core, cross-selling is all about deepening customer household relationships with products they want, they use, and they value. It is not about improper sales practices used to create unwanted accounts. That's not good for our customers and not good for Wells Fargo. If we take care of our customers, they will deepen their relationships with us and trust us more with their business. That is good for customers who benefit from the lower costs we pass on, and that is cross-selling done the right way. In closing, I'd like to talk about my commitment to accountability. When I say I am accountable, I'm referring to the actions our board took at my recommendation to forfeit the stock awards that are the largest part of my compensation for the past 3 years and any bonus this year, as well as my agreement to work without salary until the board completes its investigation. I respect and accept the board's decision. And when I say I'm accountable, I also mean accountable for leading Wells Fargo as the company restores the trust of customers, team members, and investors. Thank you for this opportunity to testify today.
Chair now yields himself 5 minutes for questions. Mr. Stumpf, to the American people, this kind of feels like deja vu all over again. Some institution is found engaging in terrible activities. There's a headline, fine, and yet no one seems to be held accountable. I mean, let's face it, the fine that's been assessed to you is probably a rounding error, again, in your quarterly earnings report. So my question is, with almost perhaps as many as 2 million fraudulent accounts over the course of 5 years, 5,000 dismissed employees, it's just beyond credibility that somebody up the food chain didn't either order this, condone it, or turn a blind eye to it. So my question to you is, who is the highest ranking official at Wells? Who's the highest person in the management team who's been dismissed because of these activities?
Well, thank you, Mr. Chairman, for that question. As you know, within, or maybe you don't know, but within the 5,300, there were managers and managers and managers of a manager. We are doing a full review.
But were these branch managers?
Yes. about 10% or more were.
And nobody above the branch manager level.
No, there was managers of the branch managers and a manager of those within the line of business. But we're doing a full review of other control functions within the company. That process has already begun. The board is going to be involved. Management will be involved. As I mentioned,
And when will this be complete? When will your own internal investigation be complete to hold management accountable?
Yeah, I can't give you a specific time frame, Mr. Chairman, but I will tell you we're moving on that directly, and we're going to get to the bottom of this.
Okay, well, is anybody at the bank holding company level being held accountable?
People will be reviewed across the board at holding company activities, corporate activities. Anybody who is involved in promoting or supporting this behavior will be held
holding
accountable.
people accountable, isn't it true, Mr. Stumpf, in the settlement agreement that Wells entered into with the OCC, the CFPB, and the LA City Attorney's Office, no individual admits guilt. Is that correct? Is that part of that settlement agreement?
I believe we either did not admit or deny. So the facts there are the facts that we agreed to.
Mr. Stumpf, let's go back to 2011, which I think is the first year we know for a fact that these fraudulent activities were taking place. The records that I believe your bank has shared with us show that 939 employees were terminated from the retail banking sector for improper sales practice in that year. Does that comport with your memory?
Yes, it does, Mr. Chairman.
Okay. So in 2011, isn't it true that Wells Fargo entered into a consent order with the Federal Reserve that required Wells to cease and desist from certain practices in the mortgage lending department, and that you paid an $85 million civil penalty? Is that true?
Mr. Chairman, that's true. That was in a different business area, but that is a true statement.
It's in a different business area, but I will read from the consent order. Quote, Wells Fargo's internal controls were not adequate to detect and prevent instances when certain of its sales personnel, in order to meet sales performance standards and receive incentive compensation, altered or falsified income documents and inflated prospective borrowers' incomes to qualify those borrowers for loans that they would not otherwise have been qualified to receive. This sounds eerily like the retail banking division. So also, as I understand it, the Fed required Wells Fargo to submit a plan to investigate and to change policies and procedures. So I think you testified on the Senate side that you were not personally aware of the problems in the retail banking division until 2013. Surely you were aware of the problems in the mortgage lending division in 2011, correct?
That is correct. And Chairman, Mr. Chairman, we shut that division down. That was even shut down.
But if you saw the problem in one area of the business, why didn't you thoroughly investigate in the other?
There's no question, Mr. Chairman, we should have done more sooner.
It just seems, Mr. Stumpf, that 5 years later, your bank is being fined for exactly the same transaction. And again, it just feels like deja vu all over again. And I hope and trust, but please tell me that these fines are not simply a cost of doing business for Wells.
Mr. Chairman, it's not a cost of doing business. This is a serious trust issue with our customer. But I also want to say there's 268,000 people who came to work this morning at Wells Fargo trying to do their very best to serve customers, and they do it wonderfully every day. And I don't want our culture to be defined by these mistakes, and we take accountability.
I understand that, Mr. Stumpf, but it appears to be a little late, and particularly when you get caught doing it 5 years ago, you get caught doing it once again. Somebody has to be held accountable. I now yield to the ranking member.
Thank you very much. Mr. Stumpf, you have said repeatedly that you were not aware of this widespread fraud in your bank until late in 2013. And it appears that there were activities going on that indicates you may have known much earlier than that. For example, in 2007, just months after you became CEO, the Sales Quality Manual for the Community Banking Division was updated with your executive guidance. As the manual states, that sales guide reminded employees of what should have been obvious, that they needed to obtain a customer's consent before opening an account. And so, am I to understand that you discovered that there was something going on and there was a need for you to do this? That manual also said that sales practices that showed, quote, questionable activity, unquote, would be sent via high priority to bank executives. So it appears that you knew something in 2007 that unauthorized accounts were a big enough problem that you had to correct your employee manual. And as early as 2008, I have documents from court filings showing your employees were contacting your ethics hotline, reporting bank fraud, and complaining to managers over unauthorized accounts. And so, it looks as if you certainly knew in 2008. What's more, I have here a consent order with the Fed from 2011 that puts your company on watch for sales quotas and compensation schemes that pushed employees to break the law. Does this sound familiar?
Ranking Member, I acknowledge that we had a 2011 order from the Federal Reserve, and I think we've always known any sales organization, you're going to have to be diligent because not every team member will do everything right every day. So we have controls built in, we have ethics lines, and I knew, and I still know that, you put people to work every day and mistakes are going to happen. It was not until 2013 when I learned that this problem had been growing, it had been more prevalent, and in a certain part of the country, which happens to be in the wonderful part of California in which you live. So these are things we've been working on. All of our strategies around training team members, which get 2 weeks of classroom training before they go out into a branch, is about doing things right, about ethics. And I'd also just want to remind the committee that there are the vast majority of our people who had the same opportunities, the same training, the same goals, who did it right every day for our customers. In fact, our customer loyalty scores now are the highest they've ever been in our company's history.
Let me just point out some other activities that should sound familiar to you. While you were under the consent order for the mortgage arm of Wells Fargo, this fraud was surging in the retail arm of Wells Fargo, but you didn't connect the dots on these high-level trends across the bank. Do you or didn't you know in 2011 that perhaps your sales incentives were driving this fraud?
Congresswoman, I knew that, at least I know today, that we should have done more sooner, but maybe, and not only maybe, some of our people, and again, it's 1%, but that's a big number for a big organization. At any one time, we have 100,000 people in our branch network, and if 800 people, for whatever reason, either misunderstood or use this as a way to be dishonest and break our code of ethics and do something wrong for a customer and something wrong for us, that's why we're removing sales goals. They'll be gone as of this weekend. In fact, we don't even think they're an important requirement anymore for us to continue to grow.
Mr. Stumpf, some people assume that you change your customer agreement to add forced arbitration clauses for checking accounts, and that these clauses prove to be incredibly helpful when you use them to dismiss multiple customer lawsuits. Is that true?
That's not true. I actually think arbitration does make sense, but in this case, for any customer that might have been harmed in this situation, we're also paying for a mediation process, so they have a mediator.
All right, thank you very much. My time is up, and I'll get to this later on, if I can. Thank you. Yield back.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Mr. Stumpf, here we go. You serve as both the chairman and the CEO of the Wells Fargo, is that correct?
Congressman, that is correct.
And as you're aware, Section 972 of Dodd-Frank requires an issuer of securities to disclose the annual proxy statement, the reason why the issuer has chosen to allow the same person to serve as the board chairman and the CEO. This year, Wells states that your dual role is a result of your extensive experience and knowledge regarding the company and provides the most efficient leadership of the board and the company. Mr. Stumpf, do you think it's a good idea for the chairman and to be the chairman of the board and the CEO?
Thank you, Congressman, for that question. In our company, we have 14 outside directors. We have a lead director. All directors are New York Stock Exchange independent by their standards. I'm not a member of any standing committee of that board. The independent directors and the lead director help set the agenda for the boards. They always have meetings that are executive session without me. And as you probably read about what happened this weekend, because we filed an 8K yesterday about actions that they took as an independent board, and I was not part of that. So the board acts quite independently.
So in these, the current situation is that you're recused yourself from board decisions on this situation?
Congressman, you're right. I have either recused or I've not been invited. I'm not part of that, and I serve at the pleasure of the board.
So you gave me a good idea of how your board's structured, but the original question was, do you think that's a good idea for the CEO to be also the chairman, and would the board and the stock shareholders, customers be better served if there was some separation in that area?
Thank you. For our company, I believe we have the right structure. But again, I serve at the will of the board, and the board can make a decision on that.
Now, Mr. Stumpf, you testified that you learned of these violations sometime in 2013. When did you inform the board that this was an issue?
Yeah, so the board had high-level ethics line comments or questions, or high-level kinds of activities around people who left the company, involuntary terminations, really through the 2011 to 2013 timeframe. After we learned,
don't you repeat that?
I'm
You said the board was having some discussions as early as 2011 about this?
I was saying that the board from 2011 to 2013 would get reports at a committee level, at a high level, about ethics lines, requests, or information at not a granular level, but at maybe at the company level.
But you didn't find out about it until 2013?
And 2013, I became aware that there was an issue in the southwestern part of the country, and by 2014 then, this was late in the year, by 2014, we started to provide more information to more committees of the board, and then by 2015, the board had a risk committee of the board had a complete report on that issue.
So as chairman of the board, the CEO, when did you tell the board we have a problem?
It was in 2015 that we had a full report. Again, as I said in my testimony to the Senate and here today, 2014 we were starting to get more granular information that this was a risk area for the company to focus on.
Did you ever disclose this issue on a 10K filing?
We have, our 10K, all of our K or Q filings are facts and circumstances, what we knew at the time. And as recently as our second quarter Q this year, when we used our disclosure teams and our compliance teams to look at this issue. The facts and circumstances, we believe, were not material.
Well, I think I just, I'm not for Congress setting, the corporate structure, but I do think there is some question here whether, in this particular situation, whether the company would be better served with those roles being separated. With that, yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Mr. Stumpf, we know now that whistleblowers first contacted the Consumer Financial Control Board about the fraud at Wells Fargo in mid-2013. And you said in your Senate hearings last week that you first found out about the fake accounts in late 2013. And the LA Times article about the scandal was published in December 21st, 2013. I have right here your Form 4 filing, which I'd like to submit to the record.
Without objection.
That shows that on October 30th, 2013, you sold $13 million worth of Wells Fargo stock on the open market. That is by far the largest open market sale of Wells Fargo stock that you made in your 9 years as CEO. So my question is, did you dump $13 million of Wells Fargo stock, which you did through your family trust, right after you found out that your bank had been fraudulently opening hundreds of thousands of scam accounts, ripping off your customers?
Thank you for the question. First of all, the vast majority of our people go to work every day and try to do the right thing.
That was not my question.
But I'll get to
Excuse me. My question was, did you dump the stock after you found out about the fraudulent accounts? Because it seems that the timing is very, very suspicious, and it raises serious questions.
I did not sell shares at the time because anything related to
But your Form 4 says you did sell the shares.
I sold the shares. Today I hold 4 times as many shares as I'm required. I want to stand with our stockholders.
Did you sell these shares or not?
I sold those shares, and I sold them with proper approvals, with no view about anything that was going on with sales practices or anything else.
Well, it seems very, very suspicious that your largest sale was right after your $1.8 trillion bank was turned into a school for scoundrels. You acknowledge that your bank fired over 5,300 people who got caught willfully defrauding your customers, and a recent lawsuit alleges that you fired even more people because they refused to willfully defraud customers. And then you blame the low-level people, you fire them, you make profits, then you dump the stock. So I just have to say that it seems that when you found out about the fake accounts, instead of helping your customers, you first helped yourself. So moving right along to the next question. Mr. Stumpf, you've said that Wells Fargo is conducting a review of all accounts going back to 2009 in order to identify any scam accounts. But last week in the Senate hearings, you were asked if you would extend the review period to before 2009, and you refused to commit to extending the review period back to even earlier. So if you were presented with hardcore evidence that Wells was engaged in some of these practices, these illegal scams prior to 2009, would you change your mind about extending the review?
Thank you for that question. We have agreed with our regulators to go back to 2011. We voluntarily said last week that we'll go back to 2010 and 2009. I've told our team to leave no stone unturned. And if we find a situation where a customer is harmed that goes back prior to that, we will make it right for that customer.
Thank you, because I have the evidence right here. And I'd like to submit to the record a court case in Montana in which 6 Wells Fargo employees were fired, among other things, ordering debit cards for customers without their permission, which is clearly illegal. And according to the court documents, these illegal sales go back to 2007.
Without objection.
So now we have evidence of illegal sale practices going back to 2007. Will you agree to extend the review period back to 2007 to cover this evidence that we are submitting today?
Again, Congresswoman, we're going to go back to 2009 if we can find, and we're going to contact every customer.
But
And if we
this
find
is evidence that it went back to 2007. My question is, and we thank you for going back to 2009. My question is, we have clear evidence that it goes back to 2007. Will you live up to your commitment of helping your customers that were defrauded with clear evidence back to 2007?
We will go back, and if we find any evidence of any customer that was harmed to 2007 through our review through 2009, we will take care of each customer.
The time of the gentlelady has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, Vice Chairman of our committee.
Thank you, Mr. Chairman. So I have the honor of representing the suburbs of Charlotte, North Carolina. North Carolina had an incredible banking culture over decades. You had, in Charlotte, First Union, homegrown bank, great reputation, went through challenging times in the economic crisis, as you well know. But before that time, they teamed up with a bank based in Winston-Salem, Wachovia. And as you know, in acquiring what was then called Wachovia, which was really First Union and Wachovia, the pitch was that your culture from California was very similar to this North Carolina culture, this banking culture. And as you well know, John Grimes Midland, who was a great chairman of Wachovia, sort of imbued in Wachovia this culture that a banker is a civil servant as well. There's this obligation to society they have and their community. You eulogized them.
Yes.
Paid tribute to that culture.
Yes.
So I want to think about that culture, because what is so sad to me is that pitch of culture doesn't conform with my experience with my constituents in North Carolina. It doesn't conform what I know about First Union, what I know about Wachovia, and this cultural pitch that you had in acquiring them in the financial crisis. I know you have a huge headcount in North Carolina, and we're grateful for it. But what's sad to me is the impact of this on them and those employees you have in North Carolina. So I wanted to look at your code of conduct that you tout. So let's look at your code of ethics and business conduct. And you said in your message as CEO, we are all responsible for maintaining the highest possible ethical standards in how we conduct our business and serve our customers. The code of ethics, in fact, says our code applies to all team members, including officers, as well as directors of Wells Fargo and Company and its subsidiaries. It also says we are all accountable for complying with the code, as well as all company policies and applicable laws. And finally, it's critical that all team members have a solid understanding of our company's code of ethics and business conduct, and understanding that noncompliance with the policy may result in disciplinary action up to and including termination of employment. You clearly have failed. You've clearly failed in your own ethical standards internally.